Hey everybody, there are some great opportunities in dividend stocks right now, especially since it looks like interest rates might stay a little bit higher than we expected for longer than we expected. Before we dive in, please take a minute, check out the link you see on your screen. It's a message from our sponsor, The Motley Fool, at fool.com/Frankel. You can get the top 10 stocks to buy right now. It's a great way to support this work I'm doing on YouTube. And again, that link is fool.com/Frankel. So again, some great opportunities in dividend stocks, especially in real estate, which tends to be a very rate sensitive sector. And I want to share two of them today, both of which I own in my own portfolio, both of which pay dividends of 6% or more at the current share prices because they're beaten down a little bit, and both of which I think could handily beat the market over the next few years. So the first one of the two is Realty Income. People have heard me talk about Realty Income before. It's the first real estate stock I ever owned. I still own it. I've never sold a share, and I've added to it many times since I bought it. It's probably my favorite overall real estate investment trust. It's a very rate sensitive company. It produces very consistent cash flow, consistent dividend income. Those tend to be the stocks that when rates rise, the dividend yields tend to rise. And because yield and stock price have an inverse relationship, you see a lot of negative pressure on the stock price in order to make that yield go up. So at the current price, Realty Income yield has a dividend yield of about 6.1%. If you're not familiar, this is a net lease REIT that specializes in retail properties. Now, you don't have to worry about what a net lease is to know that it's a good business. Most of its properties are retail in nature. There are about 14,000 properties in the portfolio located throughout the 50 states and Europe. Um, and don't worry when I say retail, because even though retail makes up about 80% of Realty Income's portfolio, they specialize in certain types of retail that are likely to be just fine no matter what the economy does or no matter how well e-commerce grows. Specifically, most of Realty Income's properties fall into one of four categories. There are service-oriented businesses, businesses that sell services, not physical products, very undisruptible by e-commerce. Think like quick service restaurants, fitness centers, auto repair shops, things that sell services. Then there are discount oriented businesses. Businesses that sell at discounts tend to do even better when times get tough, making them very recession resistant. Not only that, but they tend to offer bargains that even the best e commerce retailers can't match. Think of things like dollar stores, which is the single biggest property type in Realty Income's portfolio. Think of wholesale clubs. BJ's Wholesale is a big tenant of theirs, and more. So those are great businesses to own during a recession, especially. The third type is non-discretionary businesses. These are companies that sell things that people need as opposed to things that people want. Walgreens and CVS are two big examples from Realty Income's top tenant list. People need their prescriptions filled. They need to, buy Tylenol when they have a headache. These are things that people need. And finally, the fourth type of property that makes up the other 20% or so of their portfolio are non-retail properties. Um, for example, Realty Income owns a lot of logistical properties. They own, FedEx is a major tenant of theirs. They own a gaming property in the Boston area that's a big property, so it's actually a pretty decent portion of their portfolio that's leased to Wynn Resorts. So the proof is in the numbers. In 26 out of the 27 full years since it's been publicly traded, Realty Income has produced positive earnings growth. It's outperformed the S&P 500 handily over that time, averaging about a 14% annualized total return. Now, I don't want to get into a big economics lesson on the relationship between interest rates and stock price, but generally speaking, as the yield on risk-free investments like Treasury securities changes, REITs tend to react. Think of specifically like the 2-year and 10-year Treasuries. As those yields go down, which would likely happen if the Fed were to start cutting rates, then REIT yields tend to go down as well, which pushes REIT prices higher. So the opposite's been happening lately. Realty Income's down about 20% from its 52-week high, but I see that changing as soon as we even get an indication that rates are about to start falling. So now could be a great time to load up on this. And this is a great stock to own no matter what's going on. Very consistent income. I plan on holding it well into my retirement, which isn't for another 20 years or so. So great REIT to own. The second one I wanted to talk about is Vici Properties, ticker symbol VICI. Also has a 6.1% yield. This is best known as the gaming REIT. It was a spinoff of Caesars Entertainment several years ago. It since acquired its counterpart from MGM, MGM Growth Properties. It now owns a total of 54 gaming properties, some other investments as well. Um, just to name a few, it is the largest real estate owner on the Las Vegas Strip. It owns the real estate for Caesars Palace, which is a massive property. MGM Grand, Mandalay Bay. It owns the Venetian. It owns the Luxor. It also owns the land under the Sphere that you've probably seen in pictures. And the Venetian's actually the Venetian, which is a Vici tenant, is entitled to a share of its profits if it hits certain milestones. Really interesting portfolio there. It owns a lot of the most well-known regional gaming assets. The Borgata, which is kind of Atlantic City's best property, is the MGM National Harbor in DC. A bunch of regional gaming assets. It's also started to expand into non-gaming assets, most notably through its recent acquisition of a portfolio of family entertainment centers. If you've ever been to a Bolero, uh, Vici now owns 38 of those. They also have some debt investments, acting essentially as a lender to experiential operators, providing construction loans and things like that, and getting interest income from those. So, one of the most attractive parts of Vici's business is that all of its properties are leased on a very long term basis. The average lease in its portfolio has 42 years remaining. Very little risk of vacancy as long as their tenants are still in business. It's tough to imagine Caesar's Palace in Vegas moving to a different location, for example. And most of its leases have rent escalators that are linked to the CPI, so it's inflation protected over time. Um, Great balance sheet. It has a mostly untapped credit line. Mostly all of its debt is fixed rate with pretty low average rates. Few near-term maturities. It has a big growth opportunity, not just in gaming, as the legalization trend in gambling goes across the country, but it has a few different like embedded growth opportunities. For example, Caesar still owns some of its properties, and including properties like Paris, Las Vegas, the Flamingo in Las Vegas, and there are a few that Vici has the right of first refusal to acquire. So pretty, embedded growth opportunities. It also has a lot of non-gaming properties that it potentially could acquire. That's an area it's just starting to get into. It has a good track record of producing returns in just a few years as a public company. It trades for just over 12 times funds from operation, which is the real estate version of earnings. So it could be a great time to buy. I'm a big fan of both of these REITs. They both look like fantastic investments today. I've added to both of them in recent months, and hopefully you enjoyed this. If you like either of these or don't like either of these, please let me know. Give me your comments and thoughts. I'll do my best to respond to everyone individually. Hopefully you enjoyed this. Thanks for watching. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.